let's take the conversation forward. Sunil, good morning. Thank you for joining us. Sunil, 15% higher for the markets from the budget low. Do you think that one-time re-rating, which has happened because of budget, is already in the price, and now there's every reason to believe that market should pause, consolidate, spend some time? Do you think that would be an ideal situation? Because if you continue to run up like this, soon you will move from excitement to euphoria, and after euphoria, a bubble.
No, I broadly agree with what you're saying. The only counter to the thought process is that the rally's polarization, and what already went up. So I think that the depth of the Indian market is much broader. So I think there's a capacity to absorb a lot more liquidity. So when you're then talking about the market 15% high, you're talking about certain sectors. Now, if you break up those sectors, there are some sectors which were at very deep value. And so that 15% means nothing in terms of the catch-up. There are some sectors which were already reasonably valued because they were FII favorites. Now, there any further run-up is naturally a space where there could be breathtaking and, a little bit of profit booking. So it'll be a mixed bag in that sense. So I would say if you keep your focus on the follow-through from the budget announcements and how that's going to pan out over the next medium term, right, where it's going to benefit, I still think that there is a lot of space for upward move in prices. May not be necessarily reflective of the indices, which are in any case a narrow set of stocks.
Sunil, when I look at the data, and again we're discussing this on a daily basis, because sometimes I get puzzled. SIP flows at a record high. In fact, we are looking at record account opening as well. Great news. But if flows into mutual funds are so strong, why are DIs selling on a daily basis? Because as a mandate, most of the funds, they like to be fully invested 4 or 5% cash. The fact that the sell number is so big, which means redemptions are coming. So SIPs are strong and yet redemptions are coming. So who is selling, or why are such strong redemptions there in such a trending market in mutual funds?
So I think that two things. So let's look at investor behavior first, and then we'll look at the fund manager's behavior, right? So when you look at investor behavior, right, this 8,000 crores of SIP is a drop in the ocean in terms of money flow that's coming to the markets. You see, if you look at the overall size of the mutual fund industry, what is 8,000 crores? It's nothing. So this money that is coming in is of fresh investors, new investors. You look at the amount of demat accounts opened, those who went in and bought, Robinhood investors who have experienced that and now willing to try mutual funds. So there's a lot of excitement around mutual funds and people coming in. But the existing pack of investors who by far outnumber the new investors you're talking, who have been waiting patiently from December 17 onwards, those who came in the 2-3 year period from December 14 to 17 saw phenomenal returns. Those who booked profit, readjusted their portfolios, great. But those who just hang on there saw their NAVs gradually eroding to a level where the coronavirus March really gave them a thappad. From then on, as the market has been recovering, right, the disconnect between the economic news at the initial stages, first 6 months post-corona, and the market's behavior meant that people said, look, I've got back my capital, let me book. Now you're seeing that slowly that the economic news is actually beating expectations and the market's rally doesn't seem so unjustified, right? So this bout of profit booking, right, it will take some time to ease off. So fund managers, when I move now, so I'm saying there's a different behavior from existing investors who've been there for some time and a different behavior from new or very recent entrants. Anybody who entered post-March into the industry has seen what a fantastic industry it is because Sensex has doubled. So there is one set which is really enamored of mutual funds, but the older ones are just taking their profits, they're doing that kind of a thing. So from a fund manager perspective, this redemption flow from existing investors is far higher. That's why you see net new cash for the mutual fund industry has been continuously negative. So from one point of view, the fund manager has not much of a choice but to sell to meet redemptions. The other thing is that fund managers themselves are also human beings like investors. While they have the expertise and they are everything else behind them, backing them, as human beings, the same story I talked about for investors, right? you look at an economic disconnect and your market is another way, it takes a little bit of courage and guts to remain fully invested. So you do take profits all the time and wait for the direction to be very clear before you commit. Wait, one more. Finally, of course, the reason we are booking is because what FIs are buying continues to be polarized. And for mutual funds to be buying the same thing that FIs are buying means those valuations are going to go even more. And back to the first question, you talked about 15% rise, right? Forced the budget. So the fact is that from fund manager's perspective, he's buying from a 3 to 5 year perspective. So for him to be buying what is going up today just because an FI is interested doesn't make sense. He's got to stick to his fundamentals and basics, and he can't be concentrated like an FI. He has to be diversified. And that's the reason you've seen that over the last 1 year, right? Fund managers, 75% of the fund managers haven't been able to beat the benchmark because the benchmark has got polarized thanks to the FII. So I would say what the fund managers are doing are very sensible. They're waiting, they're picking the right. That's why you see the recent pickup in value. Because then they see that there is a chance for that value to really get encashed. Because these value stocks have been value for quite a long time. But there was no light at the end of the tunnel. Now, with the budgetary announcements, everything, you're seeing that. So you see, DIs have also started buying into those so-called value names in the Indian market. So I would say they're just being smart long-term investments in their behavior and not trying to ride the momentum or just follow the leaders.
Right. Sunil, what we're seeing is a charged up PSU space. As a fund manager, what is your own call? Because, most of the experts that we've been speaking with are a little wary about the PSU theme, and they believe that they're going to wait it out and see how successfully the first divestment actually plays out, and only then take a call on whether to go in for a long-term investment on any of the PSUs or not. Where is it that you stand on this?
So, first thing is that the PSUs are broadly classified as two bits, right? There's PSU banks and there's others, right? So PSU banks are different because there's a clear strategic process towards consolidation, merger, having a few large banks. So I think the PSU banking space has got interesting because you're going to end up with a better product. Whichever bank merges with whichever bank, ultimately it's going to be a very healthy bank. And I think it's the buying interest in PSU banks comes from that strategic disinvestment, divestment thought process government has clearly laid out, supported by your bad bank, your some amount of capitalization and all that thing around it. So PSU banks as a space has a clear reason because ultimately any economic recovery needs the PSU banks to lend there and support that recovery. And that's where their net interest margins and everything will then move up. So that's one space there where the action is happening for that reason. Now take the non-banking PSU space, right? Two things come to play there again, right? So where is there going to be disinvestment and where is there going to be strategic divestment? So strategic divestment is quite attractive because PSUs have a wealth of assets, whether it's land, historic licenses, land pockets, coal licenses. So there's a huge wealth there. And if you're going to privatize, if you're going to divest, and you're strategically going to divest, which is public sector will no longer be a serious player there, there's a huge scope for upward move. So those valuations which have been very low suddenly look very attractive and it's worth looking at, right? That's one aspect. But still, caution there in the sense that a mere disinvestment, letting go a little more of the government's holding to the public, I don't think is a great thing unless they're going to give a discount to their fair value, which we'll have to wait and see how the government approaches it. Historically, governments have tried to maximize the value, but this government is more pragmatic, and if they leave money on the table, they will be far more successful and it will be worth for fund managers to go and look at those stocks. But finally, one overarching thing I would like to say is that you have to pay attention to the sector in which that PSU plays and then to the PSU itself. For example, you see commodities, right? Commodities have been historic low as the world recovers, commodities recover. So PSUs historically have been very heavy on the commodity space. Second is defense PSUs. So I think if you look at those sectors, again, you can find pockets where the government's budgetary direction and the divestment process, right, could add value. So I would say be very selective, but there are a lot of pockets there where PSUs are looking attractive, and it's better to get in as early as you can to at least a small allocation. You can expand the allocation later as clarity emerges.
Sunil, what is it that you're making of the move that we've seen in some of those metals counters as well, because it continues to remain a trade that is largely avoided. A lot of market experts are very circumspect on this space, but owing to the movement that we've seen in some of these key prices, how are you looking at the outlook within the metals basket? Where is it that you find comfort?
So I think the comfort is in the ferrous metal space. The reason I say that is the ferrous metals are the most closely linked to economic recovery. Whenever there is infrastructure construction, right, there steel is needed, right? So that steel comes from the ferrous part. So I would say the whole stimulus that Biden's government and everybody else is putting, ultimately leading to an economic recovery, I would bet on the ferrous metal space as the space which is going to recover fastest, and that's, I would say, be top of the pack, right? The rest of the metals, whether you take copper, aluminum, they're all second derivative, right? And there's a lot more momentum and technical driven play in their pricing, which is where, because in the Indian market, right, you're not purely driven by domestic demand and supply on the metal space, because while domestic demand and supply, the prices are fixed on the LME. And there, if there are momentum and technical factors at play, you'll find lower demand here, but higher price realization because of that price. So that's a very, very tactical play. And I don't think, buying that from a medium-term perspective, just buying and holding is not probably a good idea. So like I said, to me, the ferrous metals pack is the more reliable pack, lesser of technical inputs there, more of closer linkage to world economic and infrastructure-related recovery.
Enough. That's the view coming in within the entire metal space. But Sunil, we have seen quite a bit of traction as well. We had seen within that entire FMCG basket, the kind of commentary as well that we got from a lot of the corporate voices within that space was that rural demand was picking up, and there was a general sense of things looking good within the FMCG sphere. Although of late we have seen a mild underperformance, do you believe that the long-term story when it comes to the FMCG consumption space remains intact?
See, one thing is that what's in the news is in the price. So everybody knows about the rural economy recovery. Everybody knows that farmers, have the money this summer they're going to buy. So I think to some extent the FMCG story is of the valuations reflecting the reality. Now, longer term, right, what about FMCG? See, that's a safety-oriented allocation in every fund manager's book, right? So I think that you will always get a share of funds chasing FMCG stocks as a fallback, as a safety allocation. So I don't expect much of a downside risk. At the same time, when Indian economy is getting into a growth phase, given a kickstart by the budget, is it going to be your number one performer in the sector pack? Absolutely not. So the more risk-taking you are, the less you'll take FMCG. The more diversified, the more you want to plan for ups and downs of the economy and the markets, the more you'll stock up on FMCG. So I would say that the news flow will drive this. Suppose there's a second wave suddenly coming, or one particular vaccine having side effects. If there is a bad news comes, that flight to safety will feature FMCG, because the comfort that there's a core demand always there for these companies. They are cash rich, low on debt, and they are wide distribution networks, right? And they're common everyday products which nobody can ignore. Means that safety element. So I would say that FMCG is somewhere you keep an allocation, but keep it small to medium. Right? This is not the time to go stock it up and be your largest part of your allocation, because the story on Indian economy is of growth and not of risk. So I would say that that's the right way to look at the FMCG basket.
Sure. Also, gas as a theme right now, Sunil, is also emerging higher, considering that there is the whole talk about government now putting it under the ambit of GST, which is really going to, make gas as a sector competitive. It's going to make pricing as well better. And we've seen some of the, excitement play out in the likes of Petronet, LNG, IGL, etc. as well. Is this theme attractive?
Yes, I think so. Not just the factors that you mentioned, also that oil seems to be on a rising trend. I think gas is a much more cleaner fuel efficiency as well as green energy wise. And I think there's huge reserves untapped there. And I think a pragmatic approach from the government definitely would be helpful for the sector. And I think it's a huge potential. It was there many years ago and then didn't play out. But I think it's a good space from an India's economic recovery. I think gas has a big role to play.
Okay, Sunil, great to have you on the show. Thank you so much for taking the time out and joining in today.